Good afternoon, everybody. Welcome to MarketStream, a new way to look at the financial markets. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. This is a section that we call Strategy Now. Other sections that we have, or other shows that we have here on the show, on the network, basically cover general market commentary, the events, the reactions to those events. But we don't really dig deep into a strategy, whether it's portfolio construction, income generation, or in this case, what we want to do is limited risk, limited return type of opportunities. And we're going to take a look at something called a calendar spread. Now, for those of you that are new and have never traded an option, this is going to be very straightforward, very simple. Just digest this. I won't go too fast and I won't get too in depth, too in the weeds, but I think you're going to find this very useful. Now, there's a stock that was in the news, Coke. Coke actually had some headlines this morning and also some activity, but they have earnings in July. And this is one of those blue chip bellwethers that I like to look at every once in a while to kind of get a barometer of what's going on with the general market, especially the larger institutional trade. And you can clearly see that Coke has been trading to the upside quite well. As a matter of fact, as we have noted in our other shows, I use the 20, the 50, and the 200-day moving average. That's the green line, 20, red line, 50, and the black line, the 200-day moving averages, as a barometer of who is in control. If the market price of the underlying, in this case Coke, continues to stay above those moving averages, that means the short term, the intermediate term, and the long term trader that are long are in control. So that gives me a sense of sentiment. In other words, whether bullish or bearishness is prevalent in this underlying. That's pretty simple, pretty straightforward. Now, when I look at this market, I see two things. One is a bullish activity, but the second one is it's had a heck of a time trying to get out of that $44 range. 44 to 43 is really where this range is. And this is the area that I call the battle zone, the area between the 20 and 50-day moving averages. That's where bulls will be tested in this case for Coke. So with this being said, with the market basically still hitting all-time highs or new highs every day, as a matter of fact, you see Apple though under pressure, but you're seeing the general market as I scroll up and you look at the quote detail, you got the Dow Jones, the S&P, the NASDAQ, and the Russell 2000 all at highs. You got vol up, but let's take a look at Coke and how I would look at a strategy that will meet a couple pieces of criteria. One is I only want to put limited capital on a bullish trade into anything right now. Markets are sky high. They're not overvalued in terms of fundamentals. Their earnings have been great, but what is the next catalyst? We just don't have a good sense for that, and there's so much going on. So how do you do that? Well, in the options world, you could buy calls. Now, buying calls has a limited risk. It's the debit you pay for it. And a call will appreciate if the underlying goes up. So that's great. I can look at Coke. I know that they have earnings in July, so I could look at July options. But here's the problem with just buying out outright options. You have things like time decay. Time passes, and when time passes, an option loses its value. That is something as an option holder or buyer, it is brutal. It is crucial that you manage that decay factor, that rotting factor, right? If the market stays in this grind, I don't want to lose all that premium I pay for that option. Also, strike selection. Strike selection is going to be very important. Traditionally, if we're going to use something like a bullish strategy where we're buying options, specifically call options, we're going to be buying in the money options. But today, because I want to take a limited risk, limited capital risk, that could have a potentially high reward based on that capital risk, I'm going to look at a strategy where I'm going to buy a call in Coke, and then I'm going to sell another call against it to mitigate or offset some of that time premium risk in that option that I'm buying. Let me work through the mechanics for you. I'm going to scroll down. Now, this is just a simple options chain at tradingblock.com. And basically what I'm doing is I'm going to buy a slightly out of the money option. The stock is trading at $43.69. So if I scroll down, I'm going to look at the $44 calls that expire in July. That basically gives me almost 70 days until these expire. So if the stock goes above $44, I'm going to start making money. Now for that right to be long stock at 44. Now again, I don't want to own stock right now at 44. That's why I'm buying the options. Otherwise I'd buy stock. I have to put up 54 cents or pay 54 cents per contract. That's $54. To put that into context, this is giving me a right to buy stock at $44 for 100 shares. You multiply that times 44, that's $4,400 if I want to exercise that right. To have that right, I only have to pay $50. Now that's my maximum risk, folks. I don't have to exercise that right. I could either let this go out worthless if the market's below it, or I can sell it back to the marketplace if in fact the option is in the money or starts to appreciate in price. In other words, goes higher than what my purchase price was. Of course, you can sell it at any time. Now, me being the prudent and smart options trader that I am, I know that it's a decaying asset, and I know that other factors will impact negatively that long option. So I'm going to sell the $44 calls that are going to expire in 28 days in June. You can see the June $44 calls, and for that I will collect 30 cents. So now I've mitigated 30 cents or offset 30 cents of that 54 cents I would have to pay. So let's look at the trade. I'm going to be selling one of the June 44 calls. I'm going to collect 30 cents. I'm going to buy one of the July $44 calls, and I'm going to have to pay a net debit. That's a debit. That means that is my maximum risk on the trade. A net debit right now, as you can see over here, of 23 cents is the ask price for the spread. So I put in 0.23. That means $23 per contract. Now, for you that are more sophisticated, you're wondering, okay, Joe, what's the IV, implied volatility? In other words, what's the forecast of potential violent moves in the stock as it's priced into the option? Well, right now the IV rank is coming in at 14. For those of you that are new, we use IV rank as an indication of whether or not option traders are expecting the stock to move violently. It's on a scale of 0 to 100. 100 being the most risky, 0 being the least amount of risk. And right now it's at 14. So there's not a heightened sense of a violent move in Coke between now and June expiration, as well as July expiration. What's the estimated move? In other words, what can we expect between now and the June expiration and July? Well, right now the options in June that are expiring in roughly around 28 days are expecting about an 85 cent range, either up or down. So with the stock trading at $44.68, an 85 cent range gets these $44 calls potentially in the money, and any pullback, well, that means that the June calls could go out worthless. But we can either shut down the position, or remember, just leave the July calls out there, and we only have 23 cents worth of risk. Now, the July options are pricing in a potential of $1.29, or roughly around a 2.9% range between now and July expiration. So over the roughly next 70 days, about a 2.9% range, either up or down. Again, that gets these options potentially in the money by July expiration. For this, I'm putting up 23 cents. My max profit, let's say if the stock goes up to $44 by June expiration, and hangs around there, is roughly around $32 a contract. So that means that I will make about 139% on my $23 risk. But that's not really what I want to focus on. What I want to focus on is the fact that I am buying an option that's giving me the right between now and July expiration to be long, and I'm only paying 23 cents. That's the critical part. There's only about a 30% probability that it's going to be over the $44 mark between now and June expiration, but there's over a 60% probability that it will test that level, which means that I could have the potential to take that profit. In other words, the $32 plus, I could take that profit between now and June expiration or at June expiration, which basically means that that $23 risk capital, which again is defined, was well worth my time. And so all I have to do is place the order, and then what I will do is I will manage the trade accordingly. It's currently being offered at 23 cents, and we'll see if we get filled. All right, folks, that is it for Strategy Now. So come back, either check us out on our Facebook page, which is at MarketStream.com on Facebook, or you can go to MarketStream.live, where you can check out all of our archived videos, and you can take a look at our premium content section. So take a look. And I will be back at 3:30 Eastern Time. I'm going to be doing Tech Talk. I'm going to be looking at charts and option analysis, and I'm going to look at some of the movers, what you can anticipate going into this market. All right, folks, we'll see you here at MarketStream.live.